What are qualified versus non-qualified dividends, and why does it matter? Imagine earning money from your investments and wondering how much of that income will be taxed. That's where understanding dividends comes into play. When companies pay you a share of their profits, those payments are called dividends. But not all dividends are taxed the same way. Knowing the difference can help you keep more of your money in the long run. Qualified dividends are payments made by U.S. corporations or certain foreign companies that trade on U.S. stock exchanges. To qualify, you need to hold the stock for more than 60 days within a specific period around the dividend date. If you meet these rules, your dividends are taxed at lower long-term capital gains rates, which are 0%, 15%, or 20% depending on your total income. This means you keep more of your earnings compared to regular income tax rates. Non-qualified dividends, also called ordinary dividends, do not meet these criteria. These are taxed at your regular income tax rate, which can be as high as 37% if you are in the highest tax bracket. These dividends come from sources like real estate investment trusts, master limited partnerships, or dividends paid on employee stock options. They are often paid more frequently but do not qualify for the lower tax rates. Why does this matter for long-term investors? Because it affects your after-tax income. If you want to maximize your dividend income over many years, focusing on qualified dividends can make a big difference. Holding stocks long enough to meet the minimum holding period is a key step. This strategy can help you pay less in taxes and grow your investments faster. Your brokerage will report the amount of qualified and non-qualified dividends separately on Form 109-9 division. This helps you plan your taxes and decide which stocks or funds to keep or sell. Knowing the difference allows you to build a more tax-efficient portfolio, which is especially important when aiming for steady income over many years. In short, qualified dividends are taxed at lower rates because they meet specific IRS rules, while non-qualified dividends are taxed at higher rates. This difference impacts how much money you keep from your investments and should be a key part of your long-term planning. Being aware of these rules helps you make smarter choices and get the most out of your dividend investing strategy.